Open this account, close that credit card, add yourself to this one, spend more money on that one. The list goes on and on with hacks to increase your credit score. But do they really work? Today, we're diving into the world of credit scores and debunking some common myths that many people believe. If you happen to know of others, please drop them in the comments below. Let's help each other out. Hi, and welcome back. I'm Sylvia. If you are new to the channel, I want to invite you to join us weekly as we dive into all sorts of financial and investing topics that will help you grow your net worth and build generational wealth. If you know of someone wondering how some of these common myths might be sabotaging their efforts to increase their credit score, please feel free to share this video. So let's get started by unraveling 5 myths about credit scores that might surprise you. And stay tuned till the end, where we will go over the 5 factors that are actually used in calculating your credit score. Myth number 1, closing old or unused accounts improves your credit score. One of the most common misconceptions is that closing old or unused credit accounts will boost your credit score. In reality, closing these accounts could hurt your score in 2 major ways. First, it can actually decrease the average age of your credit history, which is an important factor when it comes to your credit score. If it is an old account, chances are you've had it for a while. Creditors like seeing that you've had stable payment history over a longer term. If you close this old account, all that payment history goes away. If your newer accounts don't have the same history, you can actually lower your credit score. Second, and more importantly, closing either of these could hurt your credit utilization ratio, CUR, by lowering the amount of credit you have available to you as a whole. Think of your credit like a pie. If you have 3 credit cards, with each of them having a $5,000 limit, and one of them has a balance of $1,000, the other has a balance of $1,500, and you have one with no balance, your credit utilization ratio is 10%, which financial experts say is the ideal ratio for excellent credit score. If you were to close down the unused card since it didn't have a balance, instead of $1,500 of debt out of an available $15,000 credit, you would have $1,500 out of $10,000, which would bring your ratio up to 15%. You can say how these numbers could quickly change if the one you closed actually had a higher credit limit, say $10,000 by itself. In general, most lenders would like you to keep your credit utilization ratio under 30%. Carrying a balance at 30% or higher could cost you precious points monthly. So before closing anything, please consult with your lender. If you are not in the market to buy anything right at the moment, you will have time to recover as you continue to make your monthly payments, so long as closing that card does not push you over the 30% threshold. Myth number 2, checking your credit lowers your score. Contrary to popular belief, checking your own credit score is considered a soft inquiry, and it doesn't impact your score at all. Further, very rarely is it visible to other creditors. I want to wholeheartedly encourage you to check your credit score regularly. My friend, the time for surprises regarding your score isn't in front of your lender when you want to buy a house. On the other hand, credit cards, mortgage lenders, and auto financing companies pulling credit would leave a hard inquiry mark that is visible, and multiple hard inquiries could drop your score. The initial mortgage pull might drop you 10 points, but before you despair, if you were thinking of buying a house, know that any subsequent inquiries by other lenders will hit you way less, if at all. Many times when these inquiries all happen within a 30 to 45-day time period, credit reporting agencies understand that you are most likely shopping for the best rate and could lump all of those pulls into the same inquiry, keeping your score from dropping any further. The same can be said if you are shopping around for a car. In that case, you probably want to keep that shopping to 2 to 3 weeks. This will differ greatly with credit card companies. If you decide to go on a shopping spree and open credit cards at every major retailer, your credit can drop significantly, as these are all hard inquiries, and credit agencies will most likely consider you a high-risk borrower. Myth number 3, your income affects your credit score. This myth is one that I actually hear quite a bit. I have buyers who previously didn't qualify for a loan calling me up and letting me know that they have gotten a raise, so they are sure that their credit score is sure to go up. Unfortunately, your increased income does not directly influence your credit score. Making more money per year only helps your score if you use it to pay down any debt that you have accrued. Now, if your reason for not qualifying for that mortgage was a debt-to-income ratio that was too high, then yes, if you kept the debt at the same and increase your income, there's a better chance that you will qualify for that loan. So get your preferred lender on the phone. And if you don't have one, call me. I have plenty. Myth number 4, carrying a balance helps your score. Some people think that carrying a balance on their credit card can improve their score. But in reality, paying off your credit card balance in full each month shows responsible credit usage and can actually help boost your score. Also, don't forget your credit utilization ratio. If you are spending over 30% of your credit limit a month and not paying it off, your score is sure to drop. If you can't pay the whole thing off, do your best to minimize your balance to 10% or less. This leads us to our 5th and final myth. Myth number 5, transferring a balance to a new account will improve my score. There's a misconception that simply by transferring a balance that you are currently carrying on one card to a new card will improve your score. And while it might lower your credit utilization ratio, your score might actually drop by some points by the hard inquiry needed to open that new line. So at best, it might be a wash. But here are a couple other reasons why a balance transfer might not be your friend. Most people carrying a balance that they can't pay off are getting hit with about 20 to 25% interest per month on that balance. The allure of a balance transfer is that for a select few, usually those with very good credit scores, you may get one of these balance transfer invites in the mail with 0% interest introductory offer. Great, right? Yeah, only if you are one of the select few. But chances are, if you are one of those struggling to pay those monthly payments, you might not make the cut. Second, those 0% interest offers are only for a short term, hence introductory. And more often than not, they are not offered for free. Aside from the hard inquiry, you will also be charged either a flat fee or more commonly a 3 to 5% on that balance, whichever is higher. Plus, here's the kicker. If you are trying to transfer a hefty amount, the new card might not have a high enough credit limit to keep that amount under the 30% ratio, putting you right back where you started. That being said, I have heard of many people who have successfully dug themselves out of debt by doing balance transfers to 0% interest cards and aggressively paying them down while not accruing more interest. A word to the wise, get your game face going if you plan to do this. And there you have it, 5 common myths about credit scores debunked. Remember, understanding how credit scores work is essential for making informed financial decisions. And that leads us here. How is your credit score determined? You can't hit what you can't see. Your credit score is actually a compilation of 5 criteria that carry different weights. Number 1, payment history carries the highest weight at 35%. No surprise there. You have to make those payments continuously and on time. If you borrow it, pay it back. Number 2, amounts owed comes in at a strong second, 30%. Yep, you have to keep those credit utilization ratios down. Pay it off in full or carry no more than 10% balance. Number 3, length of credit history is at 15%. Don't close that old account yet, especially if your other cards are newer. Number 4, new credit is at 10%. Every time you get new credit, it is factored into your score. Remember, in these instances, you get hit with a hard inquiry and you have no payment history on any new credit. Number 5, credit mix is also at 10%. This is a new concept to look at. There are 2 types of credit, installment and revolving credit. Your standard installment will be your mortgage or car payment. The payment is the same every month, due on the same day until you pay it off over whatever the initial term was. Normally, this type of credit does not allow for more borrowing. Once the debt is paid, the account is closed. HELOCs are usually revolving credit lines. On the other hand, revolving credit, which accounts for credit cards, does allow you to borrow more money. As you make payments, bringing down your balance, you again have access to your full credit limit. And in many instances, when you continue to pay that off, you will get offers to increase your credit limit. You add all those together for a happy 100%. All right, my friends, that is all for today. If you found this video helpful, don't forget to like and subscribe.